Welcome to a special emergency episode of our podcast where we're obviously going to be discussing the latest events in the Middle East with the war in Iran. This is a very high action or rapidly evolving situation. Everything we are saying here, we're doing with humility. Things can change in a heartbeat. But we want to give you a little bit of more color into what is happening and what is the impact and what you should be watching for. So over the next 20 minutes, we're going to be covering essentially what has happened in the region and what is the impact in terms of freight and shipping activity on the one side, but also what it means for oil trading, oil infrastructure, deepening a bit of the outlook or the focusing, if you want, on the price action and trying to ascertain what makes sense and what doesn't. And finally, exploring a bit the future scenarios. So let's go right in. Neil, what can you tell us about the situation, what has happened, and what we should be looking for?
Yeah, I can start us off. So obviously, what a week so far. I think everybody's a bit tired, a bit jaded. Maybe I spend the first couple of minutes just going over what the market's been pricing each day. So just to bring us back to Monday, I think the market was basically somewhat in shock. It started to price the weekend events and the realization over Sunday that Hormuz traffic had slowed to a halt, basically essentially ground to a halt. The consensus view, the logical conclusion was still at that time that Hormuz is too big to fail, the flow of Hormuz. And of course, we also saw insurers pooling their war risk premiums. So that was, the major headline of the day, apart from the whole situation, of course. So it became very clear there's no more insurance to sail, nothing can sail. That was Monday.
Yeah, what do you think?
Yeah, go ahead, sorry.
I was going to say, Monday evening, it also started to become clear that maybe this wasn't something that can be done and finished in a day or two, right? We had these statements coming out of different parts of the US administration that started to point towards maybe a lack of a very definitive game plan.
Yeah, I would say that, let's not forget on Monday, everyone was expecting a much higher flat price, but to a certain extent, there's memory comes into play. We had a situation with a 12-day war where everyone was extremely bullish and then it stopped very quickly. And I know for a fact that a lot of people got hurt in the process, P&L wise. Then we had very recently the situation in Venezuela. Now, again, none of these things can be compared, of course, but it is in the back of people's mindset. And I think that on Monday, a lot of people were just pricing in cautiously the logistical constraints or the logistical situation more than any kind of supply disruption. No? And I think that's what started to happen on Tuesday, right?
Yes. So I guess Tuesday was a bit of both. We're obviously watching the situation in Hormuz, but it was also market incrementally coming to terms with the mounting supply outages. So if you just take away Hormuz issues, what we saw was an accumulation of real outage, even should Hormuz open, right? And so we've been tracking it sort of loosely. We can already track probably at least 2 million barrels a day of liquid supply to market that wouldn't be there right now, even if Hormuz was open. And the growing fear, and we should just set aside Hormuz again, the growing fear is that, let's say this war only lasts 2 weeks. We're only in day 4 or 5. What's going to be the status of regional infrastructure after those 2 weeks? So we're talking about, case in point, Fujairah, the port of Fujairah may or may not be operational right now. We've had one massive refinery, Ras Tanura, attacked several times. It's offline. We've had shut-ins at wellhead production in Iraq, worth 1.5 million barrels a day, probably a bit more. And that takes time to bring back. So remember, we're basically accumulating this stuff right now. And I think the market also started to realize that this is also a problem, even if all the escorts start to work out tomorrow, let's say. And then today is yet another kind of, let's say, twist. There was obviously the Trump tweet, Truth Social announcement that the US would start to back insurance, essentially, for vessels to sail. But the market, I guess, this morning is also balancing that against the growing story of supply chain issues, run cuts in Asia, mounting supply issues at the wellhead in the Middle East, right? So just to set the scene, on run cuts throughout this morning. More and more news of force majeure across refineries in Asia. Run cuts announced across various places in Asia. You can see some of the direct impact on that. The jet regrade, which Phil will go on to talk about, you guys will go on to talk about, is huge. The flat price of jet is approaching $200 per barrel or more. Obviously, that's maybe very illiquid. I guess you guys can think about that later. So that's the emerging story today. And on insurance, obviously, the US made some statements about backstocking insurance. I would say that got a mixed response from the market so far. And thing is also that there have been more ships reported attacked in the region. So it gives less credence to the notion that, this gives the immediate insurance needed for owners to basically go ahead and sail, right? So we're stopping short of the notion that everything is fine and we can all start to sail through Hormuz at this point in time. And I just want to add one sort of notion at this point. Even if you get flow in Hormuz at, say, 80% of normal, that's still a big problem, right? That's still a huge problem for the market. So even if stuff gets flowing again, escorts are functional, we're still going to see price impacts, and they may still be higher prices than even what we have now. And so just to summarize that, Hormuz, we don't know if it's going to get going. We don't know when and how. And the second point is the Iranians are attacking infrastructure at a fairly decent pace, even if they're not missiles in the number they were. And we're accumulating medium-term impacts. And that is what we're grappling with right now.
Okay, so let's move on to, now we understand what is currently happening. And again, it's evolving all the time. We discussed on Monday that freight is the first one that had a significant impact. Michael, what can you tell us about what you're seeing in the freight market and now, and what you think people should be doing or considering?
Yeah, thank you. So Monday, for example, the global freight market was just in a state of paralysis. Didn't matter if you were near the AG, in the East, or in the US Gulf Coast. There were no freight transactions going on, no fixtures. Bid-ask spreads on FFA paper were incredibly wide. And just as of yesterday afternoon, activities started to pick up outside of your AG region. So we're getting tighter bid-ask spreads. We're actually seeing vessels going on subs, and the market is coming back to life. And what I've been thinking about here is, what should owners do in this global scenario? So for example, the AG, there's still a state of paralysis. Freight market is frozen. Bid-ask spreads are still wide, and we're not really seeing any actual fixtures. I think that owners should start to position their fleets both on CPP and DPP into the West. Now, rates are lower in the West than in the AG, but these are actionable rates, in my opinion, rather than theoretical rates that you're seeing in the AG.
Can I ask you a question about that? Because obviously I put myself in, you're saying that the owner should be positioning themselves, but as an owner, ultimately, and this might sound like a stupid question, but the owner himself, he doesn't really care to a certain extent if he loads or not. That's more the charter's responsibility. If he fixes the vessel, it's the charter who takes the risk for it to be executed or not, depending on the circumstances. Now, shouldn't the owner be favoring a higher rate in the AG rather than secure a lower rate somewhere else?
True. So it's kind of the classic saying of bird in hand is better than two in the bush, in that your freight rates in the AG, your earnings are astronomically sky high, but it's basically impossible to get a firm itinerary. You can't get any dates for loading and discharge. So it's really impossible to actually fix a vessel with no firm itinerary.
Yeah.
So with that said, it really makes more sense for an owner to go west, where maybe your earnings, instead of being 350K a day, they're more like 150K a day. But because the West is now supplying products and crude into destinations that are much more far-flung than your typical, say, TC14 from Houston into Rotterdam, you have all of these long-haul voyages. So let's say that over the next couple of weeks, the conflict starts to de-escalate. Freight rates will come down, but if you're able to lock in a long-haul voyage originating out of the West for, say, 150K a day, you've now locked in an actual rate and earnings that you can put on your book.
Fair enough. And what you're saying here is something to bear in mind going forward, as if the situation de-escalates very quickly, you will still have that supply disruption taking place, because all of these ships that would normally do 10, 15-day voyages are now doing a month kind of voyages. So all that supply availability of ships will still be impacted, even if the situation unfolds favorably over the next days.
Exactly. And again, you really, as an owner loading out of the West, let's just take US Gulf Coast and Northwest Europe CPP at the moment, you have a plethora of options because all of your importers are trying to source their product supply from regions that are atypical. So, for example, there's been a lot of diesel inquiry coming out of Northwest Europe to deliver into EAF, Japan, and Australia. And then also, for example, US Gulf Coast saw 2 fixtures yesterday into Australia, which is a very uncommon route, loading out of the US Gulf Coast at, as James says, at 6 million lump sum. And that's really unheard of. So
Yeah.
as an owner, you can start to link some voyages together and see where your backhauls are, and you can start connecting voyages, and the earnings that you're getting on your first voyage might be 150K, but when you combine that with a potential backhaul, you're really starting to approach locked in voyages that make a lot more sense than just sitting and waiting near the AG.
Yeah, makes a lot of sense. Thanks.
And then I just wanted to comment briefly that when I look at tonnage counts, both for DPP and CPP in the West, there are enough vessels available to be fixed. And we've seen a real narrowing of the bid-ask spread and a real like coming out party of ships going on subs yesterday. So activity is now happening after that initial paralysis.
I think
Fair
a lot of those kind of longer voyages that you're talking about are being made possible because of these really wide and slightly atypical east-west spreads that we're seeing across prices, right?
Yeah, indeed.
Everyone's been looking at outright Brent and trying to figure out, why is there not quite the activity here that people maybe expected? But if you look slightly beneath the surface and you start to look at inter-regional and inter-product spreads, I think that's where we're seeing the biggest impact so far. I think if we're looking at kind of a gasoline east-west, right, it's probably the least important or the least impacted product so far, but it's already moved into positive territory and is allowing those Gulf Coast to Houston barrels to move at those kind of levels that can really support that even very high freight rates.
Yeah.
I think elsewhere, on just a very quick kind of price action roundup, obviously on the crude side, we've lost a lot of heavy sours, right? And they're very kind of typically, or I suppose as expected, things like Mars, JS out of the North Sea, the diffs on those have rallied very strongly already. But if we go back to products where I think the biggest impacts have been, it was mentioned already by Neil that something like the Singapore regrade today has been an absolute barnstormer of a morning to keep an eye on. Obviously not a whole lot of liquidity in there, but when we started to write this script up kind of yesterday evening, the regrade was at something like $15, which was already, very newsworthy. And this morning we had huge kind of upside in that, reaching up towards kind of triple digits almost. And right at the time of where we are right now, we're back at kind of $25 a barrel on a regrade. In reality, that is you've already done your full refinery, kerosene yield switching signal at a regrade of +5. I think the rest and where we are now, and maybe that $25 regrade is somehow sustainable because you're doing two things. You're trying to do two things, right? You've got some demand destruction potentially, but you're also trying to make arbs work that aren't working just on a diesel east-west alone. So you have this kind of extra level. Elsewhere, we've got HSFO cracks that are at +10. And overall, the market is pricing that there is a lack of crude and there's a lack of products ahead. On the crude side, you've got, as we mentioned, anywhere between around 2 million barrels of, I think was the latest number that we had in terms of crude shut-ins, even if Hormuz was open, mostly out of Iraq, seemingly, but you have to assume that maybe the likes of Kuwait, Bahrain, and some Saudi supply is also at risk of needing to be shut in at some stage if Hormuz can't open quickly. And on freight, obviously, we talked about clean freight, but TD25 is now at something like $70 a ton in the prompt. TI Brent spreads are compensating for that. And so it's just we're seeing that kind of product or inter-regional price spreads having to compensate for these very, very high freight rates.
No, and just to bounce on what you were saying about the regrade or anything about 5 just already is telling you that you should be switching. So question is, okay, what are those 20, 25 or even more dollars a barrel doing? Is that pure speculation? Is that panic? Is that, I mean, at the end of the day, to a certain extent, what you're doing is you're fighting for the barrel or you are fighting to destroy demand. So it's and the consequence of that is seen in the regrade, but it's a very much of a flat price kind of game, to destroy demand of it. That's ultimately what the market should be doing when you don't really have the product, or you are making sure that you get the product instead of someone else. So that's a regional kind of battle going on. So you end up with these scenarios where you have a market that is pricing something that is completely stratospheric and is already doing the job of the regrade. Now, that is something to be keeping an eye on. But James, you want to go into a deeper dive and maybe we can address some of the questions that we're seeing right now on the product side?
Yeah, yes, please. Yeah. Well, yesterday evening and this morning saw a second round of jumps in pretty much all product east-west, but particularly in diesel and particularly in jet. I think Neil and Phil have kind of spoken about that a little bit already. And these have been largely driven by actual refinery and port outages. There are growing fears, continuing fears, increasing fears about Asian refiners in particular having to cut runs. And we hear more about that hour by hour, essentially.
But is that sort of, I mean, I got the question from a friend, it's how can you be already cutting runs? Don't they already have the crude and all that to be able to produce right now? Or is it preemptively so that instead of supplying 100% now and 0 tomorrow, it's everyone gets 50%? Is that sort of the narrative right now?
No, it's actually that June, one of our colleagues was giving me the kind of full explanation on this. So typically refineries tend to hold about one VLCC of stock, about 1 week of crude stocks in reserve, as it were. And we're already at the point where they see that flow isn't coming from the AG. So they have to look to source from other regions. That can take 1 to 2 months to arrive. So what they really want to stop is the chance of shutdown. So they'd rather slow runs than cause a shutdown, because that's really a tragic thing for them to happen.
Yeah, fair enough. Thanks.
And yeah, a bit more about the east-west. So the diesel east-west has caused Middle Eastern, West Coast Indian flows to reverse and point to Asia. Now, again, as much as you can trust landed numbers on arbs currently with everything so volatile, the regrade in both Asia and Europe moves up have just been, frankly, unreal. And what is the problem, particularly with jet driving this? So we've seen, for example, the GOFO and the Widowmaker, RBOB versus heating oil, point clearly that the biggest issue in refined products anyway is middle distillates. And then when you look at what Phil spoke about with regrades, it points to the biggest issue being jet and what's driving that. The issues in the AG have the biggest percentage effect on jet exports versus market size. Approximately 20% of global daily jet exports flow through the Strait of Hormuz. For reference, 10% for diesel. Jet stocks in reserve, SPR, tend to be low. They're kind of hard to store logistically. And I guess speaking again to those reduced runs, jet is almost completely straight run. It can't really be blended up. So it's most susceptible to run cuts. And on top of that, I'm not sure the airlines really kind of anticipated this lack of jet supply. And I think a number of them are just scrambling to secure supplies. Now, we've also seen things that have really been changed over the last few months that have changed going forward. So this strengthened the Singapore regrade that Phil spoke about, has closed all Asian arbs into the US West Coast, where we've had continuing issues with El Segundo, Venecia closing soon as well. EU jet pricing, the regrade pricing up, has done enough to open US Gulf jet MR arbs into Europe. Although again, how much can you trust those landed prices on those arbs currently as well, but everything's so volatile. And as we've said, both for jet and for diesel, everything points to east. So we've kind of had like a real reverse of what's normally the case. We've got the extreme scenario where the shortest region in terms of diesel and jet is Asia. And that's going to be a continuing story, I think.
Okay, moving on to margins. Phil, what can you tell us about the market?
I suppose just a really quick kind of roundup and taking on from what James said in terms of the market now has to focus on where natural shorts are and the fact that those are getting typically shorter. So we have kind of one angle, which is these paper margin levels in terms of cracks that are going very, very high. But in reality, we're looking at runs feasibility, right? And there's a logistical issue of actually being able to run.
Yeah.
And if we take it at the top level, if we look at crude, the shortest region is Asia, right? So that's where the biggest issue is. If we break it down into products, then yes, you say that Europe is short of diesel and jet, but ultimately the first level is going to have to take precedence, and that first level is crude. So the restrictions in terms of being able to actually run the refineries are largely going to be in the east, and therefore the overwhelming kind of tightness on the product should also continue to be felt in the east.
Can I interrupt you there, because there was a question in the chat and it's linked to this. So if what you're saying is this sort of the crack should be incentivizing some sort of production relative to another, etc. But here, when you don't have the possibility of even producing it, then it's a question of flat price. The angle should be flat price. So we were ourselves here. We were saying, okay, we're not seeing this sort of price action that we would be expecting. Is it too soon yet? Are we just in the moment where we are talking about run cuts, talking about supply constraints, or is the market not really yet assessing this risk? And because again, we've seen the market go up, obviously, but we're only at 81. It's not like a dramatic shift. Maybe it's 15% higher than it was before, or 16%. What do you guys think about that? Or maybe you wanted to talk about that later on, maybe, but since we're at it.
I would just start by saying, obviously, as you said, right, the upper limit here now needs to be consumer demand destruction. So that's the absolute upper limit on flat price. And if crude isn't going to do it, then certain products may need to. And if we start to look at kind of even just a halfway scenario, Neil, you can finish now on those scenarios that we're really looking at. But even if it's just a kind of a partial reopening or even a majority reopening of the Strait of Hormuz and those kind of flows, we may still be needing to see actual demand destruction in certain parts of the market the further we go. The reason that you don't have May or June cracks super high at those levels yet is because we haven't quite seen the signal that we will have those definite issues that far down, and you don't want to lock it. You don't want kind of to be allowing almost refiners to be locking in margins for June that are actually trying to solve a problem that we have in March.
Very interesting.
I would also go one step further. Like the price induced end user demand destruction is not the final step, right? What we're talking about is potentially fairly catastrophic changes to crude supply, and it's not like there haven't been pump shortages in the past, right? So yes, there's price induced, let's say, demand destruction, but what there is a growing tail risk of is that there's actually pump shortages, let's say. Yeah, and I think that's partly what the jet regrade is trying to do. If you look at the physical margins in our tool in the Far East, then someone's written a question about this. They're not that good on paper when you actually factor in freight and diffs and stuff like that. And what jet might be trying to do is just encourage the incremental run that may not have even been possible beforehand. I think a Japanese refiner took Mars yesterday. It's not like everybody is cutting back. And of course, we're now in this kind of cat and mouse game with crude as to how big the run cuts are, how big the supply gap is. But yeah, I think prices are doing all kinds of things at the moment, including trying to get as much supply in the first problem area, which is jet, as possible.
Sorry, Phil, I interrupted you, but go ahead, continue.
I think I'm done, to be honest. We wanted to keep this short and sharp, so probably best if Neil wraps up from here.
I'll go. Yes, scenarios. Like there's always a demand for scenarios from everybody, so I obviously just split them into vague ones because there's all kinds of permutations in between the worst and the best case scenario. But where I think the current direction of travel is, and there's obviously disagreement in our team as well as everybody's team as to whether that's true, but I think the current direction of travel is that the problem is worsening. And I'm thinking more about the supply chain disruption and shut-ins and the risk of attack to infrastructure than I am about Hormuz at this point in time. The market's going to know, someone's going to know before us, whether the passage of Hormuz is going to be possible. So I'm not going to create a sort of forecast on that. But I think the supply chain disruption is accumulating. And that means I think prices will incrementally reflect that over the next week, assuming things are still going on. And that will be reflected in flat price, in Brent spreads. I think it will be reflected in margins as well. I could probably argue that margins are actually too low at this point in time, or cracks are too low, because they shouldn't be verging on negative in Asia. Let's put it like that. I think there might be a battle between where the market sees run cuts versus actual physical crude supply. So there's lots of big unknowns. A big one that's coming up is, for example, Yanbu. The market hasn't tested how much crude can come out of a Yanbu. It might be 2 million barrels per day, it might be 3 million barrels per day, it might be a bit more, which would do a lot. The Houthis probably have a say as to whether that's possible as well, but it would help. And so I think there's a lot of volatility in it ahead in terms of the market's going to mismatch how much crude there is versus how much runs we can do. And that might actually make things difficult for things like physical crude diffs ahead as well. And then going beyond that, obviously, there's going to be more SPR talk, and it's going to be growing pressure on getting a solution here. Then there's scenario 2, where the problem suddenly gets relief. I don't personally think that's the direction of travel, but the price impact is obviously going to be very fast in case that does happen. I think you already saw the impact, for example, of prices last night when Trump tweeted the insurance announcement.
Yeah, indeed.
And prices reacted fairly violently to that. But my argument would be, even if you get that, for the next couple of weeks, maybe a month, the market still needs to deal with the mess, right? And the mess includes a growing list of wellhead shut-ins. And there's a debate now, for example, in Iraq, how long does it take to get that crude back running? It could be days, it could actually be weeks. And the longer this goes on, probably the greater the time period becomes. And again, what's the status of Middle Eastern refineries after the next 2 weeks? Let's say the war ends in 2 weeks. What's the status of refineries? What's the status of Fujairah port and all the other ports? So for me, even the mild scenario is still pretty bad. And that's why I think actually Brent at 82 still doesn't make any sense. I think Brent at 82 is too low. I know we love to talk about flat price in this scenario, but it is kind of, let's say, a proxy for the physical market as well. I don't think Brent has a very steep cliff in case there's sudden peace announced. I don't think Brent even drops that low. And on the margin side, the margins, I guess, would deflate pretty quick. But again, we've got all kinds of supply chain issues to sort through. Crude procurement has to come through again, like we're missing a bunch of product supply from the market as well. So margins, I guess, deflate, but they stay at a relatively high level for a while. And on freight, I guess, Michael, you're a bit better placed than me, but it seems like at the very least, freight rates are going to drop, right? That's probably a fair statement.
Yeah. And then you have a lot of inefficiencies in the AG because of the run rates and the lack of loading and discharging. And then all of a sudden you have all these vessels wanting to do the same thing in a short period of time.
Well, thanks, guys. I see there's a lot of questions here. One of them was, do you guys see gasoline price crashing anytime soon? I think we were saying the opposite, but who wants to take this? James?
I don't have that view. I guess I agree with Neil's scenario 1. If anything, it points to things getting worse from here. But even if we get to some kind of resolution, there's been supply chain disturbances and infrastructure destroyed that will take time to come back online. So, no.
And on gasoline, we haven't really spoken that much about gasoline for good reason, in the sense that there's many other topics that are more heated right now. But there is a question from Jay here on our views on gasoline forward curve and cracks.
Yeah, I was talking about that yesterday in a commentary piece. I think obviously at the moment gasoline is the quietest product. But either way that this shakes out, or at least especially in a scenario where we have some kind of resolution and the straight run products cracks come off again as we move later into Q2, I think there's still a good opportunity for gasoline to improve further down the curve because the way pricing has come out right now is we are depleting quickly all of those stocks that we were building for summer. So we're kind of taking away from that summer buffer, and it's very bullish the further you get into summer.
There's an additional question here, quite interesting, with regards to jet. Now, we're talking about potentially significant supply constraint in terms of jet. And there's a question here from Carlton in terms of, can the US suspend jet exports and keep it for military purposes or even for internal purposes? And this also ties to the question on SDRs, so what do you guys think is going to be the immediate reaction on a let's say, political more than economical perspective?
Will they? Can they? I guess the answer is they can. I mean, the US, with regards to jets before this incident kind of downplayed, before this conflict, was already in a weird position with jet already, where kind of like jet yields have been very strong in the US. Kind of the eastern part of the US has been quite well supplied for jet, whereas we've had like continuing issues in Pad 5 US West Coast with shortages of jet, refinery issues, etc. Yeah, I guess I can't really answer. Will they? Can they? I guess they can, but
definitely they can. Will they? Depends on the need for it. No, I guess. Yeah. But sorry, I interrupted you, Neil.
No, I was going to say, but the US is relatively sufficient in their own jet, of course, and they're actually, I don't know if they're on average a net jet exporter. I think they probably are. So they don't need that, so to speak. And but there is precedent, and they did ban crude exports for a long time. So there's possibly slightly more will to do things like that than there is in a place like Europe. But it goes into some of the solvers. It's one of the other questions here. What are some solvers for jet? Let's say the runs get extremely bad in Asia. What can we do? And we were putting some back of the envelope calculations here. Let's say we can squeeze 2-3 percentage points of extra jet yield from OECD Americas and OECD Europe, plus a bit of rest of the world. That might do a fair bit. It's possible. Maybe that's what the extreme regrade is really doing, and that could cover probably OECD jet demand at the moment. But beyond that, if things get worse than that, then there isn't really a solver. I think that's the problem.
One of the solvers are related to another question is Russian diesel, Russian oil in general. Can that be a solver? Do you guys? I mean, obviously, it's only linked to certain destinations, but it's not something we've been talking about, obviously. But do you guys have any thoughts on that?
I'm not sure I would see it as a solver, purely because I don't think there's much kind of necessarily volumetric uptick possible, right? And it's all about volume as opposed to where it goes, right? So long as it's in the market somewhere, it's already doing that job of solving, or it's doing its bit. Add into that, I think we haven't really followed up too much on the reports that Novo was hit. Was it yesterday or Monday? So yeah, it would be difficult, I think, to see Russia as a solver from here.
Okay, well, guys, thanks a lot for your thoughts, your insights. For everyone listening, thanks a lot for joining today. If you want to keep following our analysis and as the situation evolves, we can give you access to Sparta knowledge, so that access to all of our market commentaries, our live prices, etc. We've been having a lot of demand for that. So obviously, right now the question is, where is the market and why is it moving? We're gladly able to give you access to that on a temporary basis. So just go to signup.sparta.app and you will be able to get an immediate access. Again, thanks a lot for joining. Guys, thank you very much and speak soon.